of risk, whether on trade, whether on geopolitics, the whole world is affected. You're also seeing as much risk in other asset classes, so whether it is equity or bonds. And some consequences is that none of the markets are therefore able to react to it, right? So what do you do? So if you sell India, do you go to China? Do you go back to US? You go to Europe? And actually, if you see calendar year YTD, most of the large markets have performed in line or even better than India. Yeah. Right? So it's not that India is outperforming. So you look at many European markets, they are actually up 25-30%. Korea is up 30%. Initially, the narrative was that money is moving out of the US market is correcting, and therefore all these markets are going up. But US market is also back close to all-time high. So I think really the challenge is on a macro basis, liquidity in this uncertainty is not really finding any asset class, maybe except gold, that is safer, and how much money can go into gold.
Okay. So, but you also remain fully invested. You're not going to cash to sort of...
Yeah, so we have higher levels in cash today than last year, but it's not like that won't really meaningfully change the return profile.
Okay, fair enough. Nilesh, very quickly, because we're running out of time, your quick take. Do you see it as a big risk, different from what we have seen over the last 3 years?
No, markets have been fairly resilient, maybe because India macros were good. But purely on these events, despite that, I think what could have impacted the macroeconomic parameters in the near term would have been a spike in oil prices. But somehow that also most experts are saying that because of supply dynamics, oil prices would not shoot up as much. That could have actually impaired many of the macros things. So that's fairly resilient. Yeah.
So that is one reason the market's not reacted as
and
one
there are
would have
flows.
expected.
Flows are supportive, so let's not dilute that thing.
Fair enough. What's your cash strategy? Because you're the one, I think, amongst the mutual fund industry that who believes in really holding a substantial portion in cash to sort of tackle with risk.
It's not linked with the macro at all, or the geopolitical thing. Wherever, Q2 result or the Q4 result season is behind us, wherever we are finding opportunities, we are deploying, and otherwise we are staying in cash. It's not linked with Iran and US war or anything of that sort.
Fair enough. So this geopolitical risk is not something that is altering your investment strategy. On that note, we've completely run out of time on this panel. Thank you so much, and thank you so much, gentlemen, for all your insights.
Amazing, really interesting insights into the consumption versus investment debate. I'd like to request Ashish Gupta to stay back on the stage, for the next segment, because it's time to shift our focus from insights to inspiration. This evening, we are honored to celebrate individuals whose investment journeys go beyond just returns. They are helping build the very foundation of India's financial future. Now, these are investors and contributors who've not only embraced smart long-term investing, but have also become role models, setting benchmarks for others and deepening trust in the mutual fund ecosystem. Our first recognition celebrates the rising stars of the industry, young professionals who are making a big impact early on in their journey. This year, the recognition goes to Deepak Pramod Chitnis for his exceptional achievement in net AUM and for exemplifying the future of India's mutual fund distribution network. The CFA charter holder and co-founder of the Investment Corner, Deepak is a standout advisor shaping the future of distribution with sharp insights and a growing investor base. Let's give him a big round of applause. Congratulations, Deepak. Up next, we honor someone who's redefining the way India invests. Congratulations to ICICI Direct for earning this recognition and playing a pivotal role in shaping the future of digital investing in India. May I request Shwetang Jagirdar, Product Lead, New Solution Group at ICICI Direct India, to join us on the stage and accept the recognition. ICICI Direct has been a digital pioneer revolutionizing how India invests. With a seamless, tech-first platform and sharp advisory tools, they are redefining the investor experience. A fintech leader in every sense. Let's give a huge round of applause to ICICI Direct. Congratulations. Well, thank you for doing the honors, Mr. Gupta. Moving on then, it's time for a very special segment of the evening. As mutual funds continue to expand their reach across investor segments, the core principle of fiduciary duty has never been more important. In this session, we will explore how fund houses can uphold their responsibility to act in the best interest of investors through transparent disclosures, responsible product design, clear risk communication, and ethical distribution practices. Please welcome back on stage N. Mahalakshmi, who will moderate this session. And to share his insights on this crucial theme, please welcome a visionary leader who has consistently championed investor-first thinking. Navneet Munot, MD and CEO, HDFC Asset Management. Let's welcome them with a warm round of applause.
Again, super excited about this discussion, and of course, Navneet is a very well recognized industry figure. He doesn't need any introduction, but people who have not interacted very closely with him, let me tell you, he has very many facets. First of all, he has a brilliant accounting and finance mind. He has steadfastly worked not only in his roles wherever he is led, but also in creating the ecosystem, led the initiative for the CFA Society, which is shaped up so beautifully. He's a thinker and philosopher. Often I've heard him quote stuff from spiritual texts. He can speak about Vedanta as eloquently as he can talk about AI. Here, of course, he's wearing two hats. One as CEO of a very trusted mutual fund house in the country, and of course the chairman of AMFI, which has been a huge driver in creating the right environment. And of course, he's taking initiatives at AMFI to a different level altogether, and it's really a delight to talk to you, Navneet.
Entirely my pleasure, Mahalakshmi. Thank you so much.
And another distinction is that Navneet has been on the investment side, and one of the few people who has moved from investment side to become a CEO. So I'm going to start with that, Navneet. As we've discussed in the first session and also in the address that Mr. Amarjit Singh made, there is often a conflict between what is right for the investor and what is desirable or what business wishes to accomplish. And as a CIO or as a fund manager, you're often more cognizant of the risks that the market poses. As a business, you are more focused on what you need to achieve in the next quarter and the next year. In your roles as CIO earlier and CEO now, tell us some instances of how this push and pull has played out, and how real is this problem and how are you solving it now?
So I strongly believe, I think a few years back, somebody in Moneycontrol did an article with me, and they asked the same question, and I said there cannot be a trade-off between the interest of the unit holders and the interest of shareholders. And if there is a trade-off between them, then in the long run, both won't be a winner. You cannot build a business where you don't put customer at the center of everything that you do. our business, our dharma is fiduciary responsibility. And if you are not following that dharma, then shareholders cannot benefit in the long run. And again, I repeat, in the long run. You can always, maybe for a quarter or for a year, you can take a shortcut where you think that this is good for business, may or may not be good for unit holders, but that may not create the sustained value for shareholders. And I've always strongly believed that there is no trade-off. I think it depends on the time horizon. If you extend that, and shareholders are like perpetual investor, right? I mean, there is no end date to that. If you think about that, then how can there be a trade-off?
Okay, I'm glad you say that. Now, obviously, because this
I use that word dharma, and you talked about the spiritual. So there's no English translation or translation in any language of the word dharma. Dharma is very unique to us. And the dharma for us, dharma is like pani ka swabhav hai behna. There's a dharma of water, there's a dharma of air, there's a dharma of, let's say, whatever. The dharma of us is fiduciary responsibility. And there is something called dharmen rakshati rakshita. If you do the raksha of dharma will do raksha of you. And I think if our dharma is fiduciary responsibility to our unit holders, they will ensure that the business does well in the long run, yeah.
But as a CEO, you are bound by karma, right? I mean, dharma bhi hai, but karma bhi to important hai na?
So
karma is not in conflict with dharma here.
They cannot be disconnected. There cannot be a disconnect. And in the history you go back, everything, whether it's a Mahabharata, Ramayana, everything, it's all about whenever you had a disconnect between what your dharma is and what your karma is. If you have a disconnect, then the outcome won't be good.
Okay. Now, it's interesting you talked about fiduciary responsibility because we want to spend a lot of time talking about that. How seriously do you think now there are a lot of, nearly 50 players in the industry, how seriously do you think this fiduciary responsibility is really taken by the industry? What is your sense?
So I was deeply impressed by Mr. Amarjit Singh's presentation, and he rightly talked about the many things that SEBI and MFI together have done over the years. I think this is an industry which is like, I would say, one of the most regulated in the world. We are highly governed. The structure of the responsibility of AMC board, the responsibility of trustee board. In fact, the trustee board structure is not there the way it is in India, in many of the countries, and then the role of all the committees, the audits. We are hugely publicly scrutinized by people like you simply because you have so much of data and information in the public domain about us. You don't get that much of data and information about any other industry, and that's why you don't see a deeper analysis the way you see about us relatively anywhere else. But at the same time, you mentioned that over a period of time, it's not only the job of the regulator, or regulation alone cannot lead to the outcome that they would like to see. And that's where the role of the culture, that's where the role of having a sense of purpose, that's where the role of all stakeholders in the markets who have to strongly believe in, I won't quote too much from, let's say, Indian scriptures, but let's say Adam Smith, he says, trust is the oxygen of capitalism. Trust is the oxygen of capitalism. If you want growth and if you want like markets to do well, and if you don't put trust as the foundation of that, markets will collapse. It cannot sustain. And that's where I think the role of all of us, there's a collective responsibility on all of us. By the way, in our industry, if I remember correctly, from 2007 to 2025, the number of players hovered around 45. They remained same. I think you will meet a lot of people who have set up AMC, you will meet a lot of people where it got merged or maybe got closed, but the number of asset managers did not change. The industry grew from few lakh crores to 70 lakh crores. Now you are seeing a substantial increase. We would have crossed 50, and next year you will see probably 60 players. And I think, and several of them don't come from an institutional background. Several of them are, or most of them are professionals. And I just hope that they keep one thing in mind, that this is the most noble job in the world. This is the most noble profession in the world when you're dealing with somebody else's money. And over a period of time, it has to go from, let's say, one individual who's starting with few people. How do you build that institution, which is very important? Because it's not only about failure of one player, the impact it will have on the trust of millions of investors who are putting money in the industry.
Fair enough. And you have been instrumental in creating this, ethics committee. And I do remember when you were just taking over as AMFI chairman, you were telling me that, this is what you want your legacy to be, in a sense. So you tell me more about the ethics committee. What do you really hope to achieve? Because my question is, at an industry level, you can put practices, you can put standards, but in the end, if you don't reprimand the bad players, if you don't take action, if you're not able to enforce, nothing really changes. It's just on paper. So how do you steer this really?
So first of all, this is not an enforcement committee. The ethics committee, consisting of stalwarts like Mr. Mahalingam, who was the whole-time member of SEBI, Mrs. Shamala Gopinath, who was Deputy Governor of Reserve Bank, and Mr. Vishwanathan, a lawyer. The idea was that, and the discussion was that we are highly regulated, we are highly audited, we are like publicly scrutinized so much. We have all the regulation, then code of conduct, we have so many best practices
in fact, many
on
of your
almost everything.
competitors feel that,
then why do you need that?
Correct.
But this is where also, I think as Mr. Amarjit Singh, going back to his presentation, he said that we want industry to be more and more, doing the self-regulation. And it's about like, if there could be matters. See, in our industry, in financial services, I always say, the line between ethical and unethical, the line between what is right and not right, the line between what is legally allowed and not allowed, that's very thin. And there could be like the issues of ethical dilemma where you may need wisdom of other people. Again, like Dharma of India, the concept is very unique relative to all the other religions because the Dharma is contextual. Every situation would be different at that point in time. And maybe the wisdom of some of these people coming from the background they come from, and maybe over a period of time there could be more members of looking at things from a different lens than just trying to interpret a best practice or a regulation in a highly mechanical or in a highly, I would say, from a legal lens of that, yeah.
Okay. Now, another question. As a, industry, head of an industry, how do you really create consensus amongst, now we are about 50 mutual funds. They're all kinds of sizes. Different plays in their growth trajectory, small and big. And obviously, not everyone's interests are really aligned, right? Like many, at the bottom 25 may have very different goals and may want very different kind of guidelines compared to the top 10. And this has been a thorny issue at several levels. I'm not getting into the details, but how do you build that consensus and make sure that, the smaller ones are heard and you're able to sort of foster, build some kind of a consensus, but that suits everyone, not just the big boys?
First of all, this whole debate on big boys and the smaller ones is not right. So we got set up in the year 2000. There were 26 AMCs on that day. So we were the smallest. And our license number was 44. So there were 43 AMCs before us. Somebody's became big, and the only asset manager that would become big who would have done well for their unit holders, who would have done well for all the stakeholders, and this is an open market for everyone. I think AMFI is a very unique example for any industry body, not only in India but in the world. The way all the 45 plus members, I think, come together and collaborate. During the day, we would compete very hard against each other on many counts. But at the same time, when it comes to the industry's interest, I think our interests are completely aligned. And just looking at your title was what? Truth, Transparency, and True North. So for us, I think we all believe that truth is the foundation, transparency is the path, and True North can be like your compass. And I think we all of us agree on several things, that best practices are very important. We all agree the importance of financial literacy, the amazing work that has been done I think by all of us jointly, the amazing amount of work we all do together to coordinate, collaborate with the market regulator. Again, this is a very unique example. In most of the industries, they would always have a very conflicting or a very combative approach towards the regulator. In our case, it's always a co-creation between the regulator and us. And of course, that's how we deal with all the stakeholders, which includes our advisors, distributors, the other ecosystem partners like RTA, KRA, and all of that. And I think it's been like wonderful work done by people over the last 30 years.
Sure. Now, one thorny issue in the industry is this, launch of NFOs. I mean, lots of them. And this is something I think the regulators have also pointed out. Industry people also point out that, but still, there is a certain kind of incentive for AMCs to go ahead and launch NFOs, and many of them do it as a gathering strategy, not really focusing on whether it is a durable product, whether it will sort of stand the test of time, and so on. Where do you stand on this as an industry? What can you do about an issue like this?
So you reminded me of my investing days, and we used to say always that the 4 most dangerous words in investing are, this time is different. And I always say in our industry, in business, the 5 most dangerous words are, so the 4 most dangerous are, this time is different in investing. The 5 most dangerous, and this is a standard line I say in every my induction program, all the interaction with my people, everyone else is doing it. The 5 most dangerous words in our industry is everyone else is doing it. You shouldn't be doing something because everyone else is doing it. You shouldn't be doing an NFO because this is the easiest thing to sell. It should be something that your investment team has a conviction in. It should be something where you think that at least a segment of investors and a segment of partners have a space for it in their portfolio, and you have a capability to match that. And then, of course, all the other issues regarding the timing, the capacity of how much money you can take, the universe and all. The one good thing is over the years, and this is again credit to SEBI, that lots of guardrails have been put in place for the last couple of years. For example, I mean, if you do a sector thematic fund, then minimum 80% in that sector thematic, which again is like very, very well defined. You have a benchmark which has to be very, very close to the theme or the sector that you are doing, and SEBI does a lot of screening of that. At the same time, I think in a market which is evolving, markets are like so small in terms of overall size relative to the size of the market. We were like 4% of the market. Now we are getting almost close to the 10% of the market in terms of ownership of mutual funds of the overall market cap. I think there is space for innovation, but that innovation should not come at the cost of making products a lot more complex or products which are not good for the end investors.
Sure. Here, again, I want to ask you something that is very, very fundamental, that, at a certain level, almost all, I think, in the previous panel, except for Rajiv Thakkar, and a few AMCs where people take very effective, very strong, proactive cash calls, etc. It's taken as a given that, people have entrusted the fund manager with the money, we have a mandate and we will remain fully invested, etc. But for most part, most investors don't know what they are doing. They've just chosen the product because it's an HDFC or an SBI, etc. The onus of, making the investor aware or guiding is also rests with the fund manager. So how do you sort of respond to that? Because you're saying, hey, I have created like 26 products. It's up to you whether you want to invest in the defense fund or the EV fund or the large cap fund. But I'll remain invested. But like Steve Jobs says, the customer doesn't know what's right or what is...
Again, going back to the scriptures. So the 2 most important things are in Indian scriptures, the way they are written. One is like, and I think in the Mandukya Upanishad it comes, Satyam Eva Jayate, which is like the in Indian emblem. Just one second, let me complete this, the way it comes. So the meaning of that is the truth alone triumphs. Truth alone triumphs. Now, how do you get to that truth? The second concept is neti neti. Not this, not this, not this, neither this nor that. And you constantly work on that. So think about it. So let's say you say, my fund man has done very well. Neti, neti. Neti, neti is, you're showing me last quarter, you're showing me last 1 year. Show me 3 year, 5 year, 10 year, 20 year since inception. Then it still says very good. Neti, neti. Compare with the benchmark. Neti, show me like how you have done it, show me the portfolio, show me the sector, show me your turnover ratio, show me this, and it just kind of like goes on and on and on, till the time you come to that. Now I've shown all of that, and then you say, yes, fund managers really done very well. Whichever way, all the ratios I apply, Sharpie and whatever we disclose in fact sheet. Then you say, no, the fund manager manages 3 funds. What about the other 2? Is it that he's done or she's done very well in this? Show me the performance and all the parameters of that also. Neti. And then that's how you get that Satyamev Jayate, that the truth alone triumphs. And all of that. And again, as I said, like dharma is very contextual and very individual to everyone. If an AMC, and you discussed that in the previous panel, if they think that given where the market is, given where the valuations are, they're comfortable with that cash, as long as investors understand that, as long as distributors understand that, and in their asset allocation overall, they're comfortable with that, they need to take that call. Somebody else may have a different view. But broadly, there are like so much of disclosure, and that's why I said that transparency is the path towards that, the ultimate truth.
On that note, thank you so much, Navneet.
Thank you.
Again, running short of time, but thanks so much.
Thank you, Mahalakshmi and Mr. Manoj, for such an engaging conversation. Mr. Manoj, I'd request you to come back on stage to kindly, as we move into our next set of felicitations. It's now a time to celebrate the individuals who have demonstrated excellence, innovation, and impact in building investor confidence and accelerating the growth of India's mutual fund ecosystem. Our next recognition is truly special. It celebrates the spirit of leadership, resilience, and excellence in the world of mutual fund distribution. And the recognition goes to Jennifer Mendes for her remarkable achievement and for being a shining example of dedication, trust, and empowerment in the mutual fund ecosystem. Jennifer Mendes from Goa is an inspiring leader with over 20 years in mutual fund distribution. Her efforts in empowering families and women investors make her a true symbol of Nari Shakti. Unfortunately, Jennifer couldn't be with us to receive the felicitations, so her son, Schubert Mendes, is here accepting the honor on her behalf. Let's give him a huge round of applause. Well, our next recognition goes to Aditya Birla Capital Wealth. May I request Piyush Bishnoi, Head Product and Research Wealth at Aditya Birla Capital, to join us on the stage to accept the recognition. Aditya Birla Capital Wealth is a distribution powerhouse leading the charge in the Western region. With a strong investor network and commitment to financial inclusion, they continue to set benchmarks in mutual fund distribution. Ladies and gentlemen, a huge round of applause for Aditya Birla Capital Wealth. Congratulations. Moving forward, our final recognition of the night goes to Axis Bank. Now, Axis Bank has been a trusted leader in financial services. With wide reach and digital strength, they have empowered investors across India, driving deep engagement and mutual fund access. A true force in investor inclusion. May I request, of course, Amar Simha Baiji, Senior Vice President, Axis Bank. He's here on the stage with us and accepting the recognition. Please give them a big round of applause. Congratulations. Well, congratulations to all our honorees. Your achievements are a true reflection of passion, purpose, and performance. And we celebrate each of you for raising the bar in this ever-evolving industry. Thank you, Mr. Manoj, for doing the honors. Well, moving on then, it's time to dive into a conversation that's both timely and transformative. Gen Z, raised on a bull run and fire dreams, has recently faced a reality check with market corrections. Yet they remain bold. Nearly 45% of investors under 30 consider equities as their primary investment, with over 70% of their portfolios allocated to stocks. So how do we help this digital-first generation save smart, invest better, and stay invested? Now, this session will explore how wealth tech platforms, advisors, and distributors can build trust, encourage discipline, and deliver personalized experiences that truly speak to Gen Z's unique mindset. I'd like to invite on stage Abhinav Kaul to moderate this discussion, and let's find out what it takes to connect with this rising investor class with Sandeep Jetwani, co-founder Deserve, Dilshad Bilimoria, founder, MD and Chief Financial Planner, Dilzer Consultants, Vishal Jain, CEO Zerodha Fund House, and Ashish Singhal, co-founder CoinSwitch and Lemon. Please welcome them with a big round of applause.
And welcome to the Gen Z panel. So at a time when the mutual fund industry is nearing or powering towards the 100 trillion milestone with 70 trillion in assets as of now, the role of Gen Z population is something that we cannot ignore. Now this generation is very much interested in spending, but as we have seen with the new investors that have come into the market fold, they are heavily into investing as well. But it looks like many of these young investors that came after the COVID-19 pandemic, they took high-risk bets in crypto, FNO, direct stocks with not much guidance. So in this panel, we'll discuss in an era where there are n number of options and there is fleeting attention, then how come as an ecosystem, we with mutual funds, advisors, distributors, and wealth tech platforms, how can we build better relationships or better investor decisions? Vishal, if we can start with you, like Gen Z population age is generally 13 to 28 years. And in 5 years or so, this population is going to drive mutual fund growth. Now, when they are tech savvy and they can switch buy, sell at the click of a button, is it good or bad for a mutual fund which requires a lot of patient investing?
Yeah, can you hear me? Yeah. So good question, Abhinav. I mean, keeping in mind that, look, at the end of the day, humans are humans. I think we've all been through ups and downs in life. I mean, I remember when I started off my career, at that point of time, derivatives have just started, you know, way back in 2000, 2001. We all dabbled in the market. We all took punts in the market at that point of time. A lot of them went right. Most of them went wrong. And you learn and grow in that sense. And obviously the ones that go wrong, you automatically become a long-term investor, yeah, right? And that's how you keep growing and learning. And I think that if you look at the current, you know, age group, I think they're highly informed. You know, they learn fast. They have a lot of information in their hands. And I think that, you know, the cycle that we went through maybe 2 decades ago, they'll go through it you know, faster in that sense. I would just like to say that, you know, from a perspective of mutual fund investing, I think, you know, as even all the other panelists in the previous panels alluded, we keep talking about the fact that, you know, one should look at an asset allocation. That means keep investing across assets, whether it's equity, commodities and debt, and even within equities, look at various segments of the equity market. Keep investing regularly, stay the course. I mean, a lot of times you find that if markets fall, people stop their SIPs. You know, keep doing your SIPs at regular intervals. And as I said, you know, to reduce risk, ensure that you have a good asset allocation with you.
Right, right. Now, Sandeep, these young Gen Z investors prefer apps or wealth tech platforms, direct investing. So do you think by directly investing into the market, they are making empowered choices, or are they letting go of personalized advice?
No, I think, you know, first of all, the Gen Z, you know, you spoke about recency. effect and how in the last few years returns have been good. So therefore, how are these guys reacting? And I actually feel that the reason recency bias is a term is because it cuts across generations, right? It has been there for a reason. Most of the Gen Z are actually significantly empowered and aware, right? One of the things that we find in our engagements, and we deal with them on video calls, so we actually learn a lot more about how they behave, is that consistently they know enough and more about investing. In fact, there are times when, you know, we have to up our game to be able to keep them engaged and educated, right? So they actually know really well. What our job is constantly to bring back discipline. And in doing that, how do we communicate is actually very important. So even for digital platforms like us, the mechanism, the storytelling that we bring is really, really important. Like, you know, recently there was this question on how, or should I follow a FIRE goal, or should I create a certain corpus and then retire? One of the clients I was speaking to, he told me an interesting phase, and he's a 30-year-old who made some money off ESOP buyback. He said, Sandeep, we have to be really careful when all my friends are talking about FIRE, because I tell them that FIRE is fueled by irrational return expectations. So he gave a new definition to FIRE. Now that coming from somebody who is a 30-year-old, who's read up about the markets, who has ChatGPT at fingertips, I think is fascinating. So I think the real responsibility for all of us is to up our game and be able to communicate in the way that they understand.
Right. You mentioned FIRE. I mean, maybe to achieve FIRE, many young investors might have gravitated towards riskier assets. Now, Ashish, you are founder of two companies. One is a CoinSwitch crypto exchange, another is Lemon, which is more into traditional assets. And we have seen a lot of young investors came into crypto after 2020. So with the recent crash, did you see any change in their investor behavior, maybe gravitating towards more conventional assets classes?
Let me take a step back first and say thank you. This is the first panel in last 5 years where somebody has actually said crypto on stage. And I've been in a lot of fintech panels. People call it alternate asset rather than crypto. So thank you for doing that. And acknowledging, that crypto has been a newer asset class, riskier albeit. But investors, the Gen Z investors, because 70% of our users are Gen Zs, right? And how we have learned to cater to them, because crypto fluctuates a lot, being a new asset class. There's a lot of fluctuation in the market. I think trying to help them learn better, trying to figure out whether, the fluctuations are something that is part of the game itself, or should they start allocating some part outside and look at this as a riskier bet, which could either pay off handsomely or which could, go to zero and still not hurt their portfolio, right? I think a lot of Gen Zs have started to understand that. In the recent times, we have seen some of them doubling down on crypto because they feel like, oh, this is the asset class they want to be in. Some of them start to realize that, crypto, I will only allocate 5 to 6% of it, and rest I will go to stock market, mutual fund, and do more passive, so that I have a sustained portfolio over the period of time. And that is the reason that we have Lemon as well, because a lot of our users wanted, alongside crypto, how can we do traditional investment better, simplified, and that is the reason, we have both the products out there.
Right. So, I mean, so do you have a sense of extra responsibility towards investors? Because, I mean, crypto is still unregulated, and we have seen some hacks happening, unfortunate events happening in the industry. So what extra do you do to reach out the message to these young investors?
I think I think I'll answer it in two parts. First is, how do you build trust in a digital ecosystem in a sector which is unregulated? And second, how do you mitigate or, instances like hack, fraud, which are happening in this industry without a regulator? So I'll answer the second part first, which is, when a regulator is there, our job becomes slightly easier because there are guidelines that you can follow. And ultimately, within the spirit of those regulations, you try to build your product, reach out to users, and try to sell your product. In crypto, the regulations do not exist. There is no clear regulator itself that exists. So we have to do a lot of self-regulation. But with self-regulation, the problem is that, business will always push to get more business, and, you'll try to take shortcuts. What we have learned over the 8 years that we've been operating CoinSwitch, the only way to build a sustainable crypto platform is to think of long term. What the MFI chairman was talking about as well is that it is not a short-term game. Ultimately, you have to look towards long-term, and so sometimes you compromise your business as well. We have taken calls where we have not listed tokens which we feel are risky. We have taken guidance from mutual funds and invented our own riskometer for crypto, so that we actually advise platform. We are the only platform in the world which advises to not to invest in certain tokens because they are highly risky, right? So I think taking that helps us do better. And answering the first part is about brand. Our digital first branding plays a key role. How do you communicate trust? So the founders have to be out there, because Gen Zs are, are social animals, right? They're looking for people who are like them, building platforms like them. So as founders, we need to be out there communicating our vision to them, helping them understand crypto in a bite size, maybe, TikToks, and creating more Instagram reels rather than creating long form articles, right? So building trust through brand is equally important.
Right, right. Now, Dilshad, talking about the long-term investing, you are the lone voice of advisor on this panel. So, I mean, traditionally, the sense is that long-term investing starts at 5 years and goes further. But with the younger generation, I feel like sometimes the investment horizon is like 1 year or maybe less. So, what is your experience like with the Gen Z investor while advising them, and how challenging is it for you to advise someone with the mindset that the 1 year is the horizon?
So I'll take off from where, and thanks for having me on the panel. So I'll take off from where Sandeep started, actually. I think the Gen Z is very, very well informed. They know what they want, but they don't know how to get it. And for example, if they were to come and research RIAs, they have already checked my background. They've already checked who, how many years of experience, what I do, etc. And they say, okay, this is what we want. They just want it to be validated. Is it the right thing? Is it the right way about going about this? Should we make changes? So I think that kind of validation is what they're looking at. Now, coming to their requirement of short-term, long-term, FIRE, retirement, etc., I think for us, it's a journey of taking them through the education and the financial literacy of where they are today and where they want to go. So, we start with what exactly are they looking at, what are their goals, what are their objectives, so I mean, ours is quite a traditional kind of setup where, we do one-to-one, we do a lot of counseling, we do a lot of financial education, and then we move into the actual of, why of investing. And I think that has helped people kind of tone down their aggressiveness. We also talk
aggressiveness
about
in terms of return expectations?
Return and also quick money. So when I spoke to my kids, I think the first thing they said is, how can I make fast money? How can I make returns the fastest, right? I think there is no shortcut to success, right? Everything is a process-driven way. So I think giving them that counseling, that financial education, and making them aware that, this is where you need to go, this is where you are, and these are the ups and downs that you will see in the interim. And I think that journey explaining, they well understand and then move forward. Yeah.
Right, right. So, Vishal, at a time when the churn rate is higher, I mean, Gen Z or this new generation will look at a theme, invest, it's not performing, move out. So, how can we make them stay longer in the market?
So again, as I said, Abhinav, I guess we have to keep, drilling in their minds all the time in terms of, the same thing in terms of asset allocation, in terms of, a core and satellite kind of an approach where the core becomes, the main reason in terms of why you're investing in the markets. Typically, most of us will invest only because of 2 or 3 main reasons. One is to beat inflation. One is to, benefit from the India growth story. and that kind of investing in a diversified, fund, passive fund or an active fund is where, that should be the kind of core of the portfolio. And if you want to take risk, that should be in the satellite portion of the portfolio, which could be, depending on your risk-taking appetite, it could be a 80-20 mix, it could be a 70-30 mix, it could be a 60-40 mix, depending on how much risk you want to take. And that's something that, we need to keep drilling in and ensure that, we keep talking about, as Dilshad said and Sandeep said, that keep talking to them, keep showing data to them, keep, making them understand in terms of how do you calculate returns, how do you calculate risk, what are the upsides and downsides of the market, and it's just a constant education that all of us need to do in the industry.
Right. But Sandeep, do you think this message of boring investment, asset allocation, don't chase returns, does this message resonate with the Gen Z investor, or do you think we need a new communication method to reach out to them?
Look, I think we need to recognize that investing is exciting, right? Now, how do you ensure that that does not translate into too frequent actions is the problem to solve, and that's how we deal with it, right? For us, we manage money for most of our clients on a discretionary basis. So actually, it's actually doubly harder because we're asking them to leave it with us and then we'll handle it, right? Therefore, what we have tried to do is with these folks, be actively talking to them about how we are thinking about the markets, what are the actions we are planning to take, what are the reasons why we are not taking actions at a certain point of time, right? Once that engagement is established, the pressure to act on their side is significantly lower. And over time, then we've realized that it's all about communication. Most of the time, somebody wants to react or act when they are nervous or they are excited about something, and they don't have an outlet for that emotion, right? If in the conversations we are able to discuss it, we are able to engage with their energy and excitement, it does not translate into portfolios. In fact, I actually feel that when we look at the portfolios of younger clients, are they more impatient than potentially older clients? The answer is no. One of the clients I was talking to recently, he runs a small business out of Bhilai, and something around a steel business. And he was telling me that paisa paise se banta hai, so I want to leave the money with you, I don't want to spend it, right? Now that's such a fascinating thing coming from young folks. I think the industry, mutual fund industry also has done a fantastic job of educating that. I think the grounding is solid. We just need to engage in a way that they don't react too often.
Right. Now we are running out of time, but I have one round of questions to go. Dilshad, you are mother to 2 Gen Z kids. So what has been your experience like? And what do you teach them and what they teach you?
I think they're fed up of listening to me passively speaking to.
Do they invest on their own?
Yeah. So very much. So
have they beaten your returns?
Sorry?
Have they managed to beat your returns?
Well, they've not been allowed to invest in crypto. So, yeah, but I think the good thing is they've grown up listening passively to the importance of saving, investing, long-term growth, wealth creation. In fact, a funny story is when one of my cousins was down from Mumbai, my son started explaining to her the SIP and compounding and STP, and he spoke and answered all her questions. And then finally, when she came to a difficult, he just looked at me and said, okay, now what are you going to say? I mean, they've heard it in and out in their thing. And I think the discipline of starting early. So even my older son, who's 21, he today has actually built 2 lakhs with no earnings. He's just starting his career today. Younger one is too young to, of course he's 16, but still too young to understand the importance of money and saving and investing. But I think that is, half the work done when, they have actually realized that money doesn't grow on trees. You need to work hard for it. You need to save. You need to invest. And we did that right from the beginning, right? We used to give them small amounts of money if they did chores well, etc. So I think that value comes from the parenting and the upbringing at home as well.
Right. I remember during COVID times, Mr. Kalpain is in the crowd. He shared some lovely videos with his kid, explaining global companies and talking to his kid. Any advice that you would like to give to parents who have like 13, 15, 18 years old at their home, how they can introduce financial lessons, money lessons to them?
Well, just recently there was somebody in the industry who said that what we do is we try and ask the children to come if they're about 15 to 18 with their parents during our goal review discussions. Because that's when they're actually finalizing their education, their undergrad or postgrad requirements. And we want the children to realize how much the parents are saving towards these goals and that it's not kind of simple or easy to work up such large numbers. We also at that time try and finalize universities, costing, solutions of which area they want to go into. So it becomes a very nice family discussion and sometimes a very heated one too, where I just step out and then they discuss and then I come back again. And so I think bringing children into these conversations at an early age would definitely help. And giving them, making them understand the value of money at a young age, making them realize that, you're not born with a silver spoon. I think these are some of the parenting habits, I did. I don't know if they're working or not.
Right. Now, Ashish, between people and apps, where does the future of investing lies? Or this answer is somewhere in between?
I think definitely something in between. I want to address one point before I answer this, is that I think we are talking about different set of Gen Zs when we are talking to this panel, right? One set of Gen Zs is who has money, who can hire financial advisors, and they're smart. The other set of Gen Zs which I deal with, I have 2 crore plus users registered on the app. I don't have the luxury to call every one of them and explain them what is investing. And that is where there is the other world who doesn't have enough money to hire a financial advisors, which we are solving for. And I think there are different problems set to solve for both. Probably we'll discuss it separately, but I just wanted to say that out loud, that there are 2 set of Gen Zs that exist in the world. Sorry, your question was between people and AI. I believe in the next 5 years, you will see a lot of AI-assisted investing, not AI-automated investing. So you would see a lot of people get access to information right on the apps who have smaller money and still want to make good returns in their investment, would see a lot of assistance through AI, and apps would actually help them do things better, faster. And today, the biggest problem in the industry is that users don't learn from their mistakes. They make a mistake, they forget about it and move on. And they repeat that mistake multiple number of times because they don't have an advisor who can guide them in the right direction. And that is what even we are trying to solve, is can you learn from your bad decisions, and we can remind you at each investment that this is the bad decision that you made. Are you getting into that trap again, or can you do better? Right? So I think a lot of mixed approach of AI with powered with the human intelligence is what we're going to see in the next few years to come.
Right. One question on mutual funds, Vishal. There are a lot of themes, fancy themes that have come up, defense, EV and all. Do you think there are enough guardrails within the industry to safeguard young investors?
As I said, the industry is doing its bit to, to educate, investors who are investing in these themes. But you have to understand one thing, that at the end of the day, these products are being launched to, to allow investors to take differentiated kind of exposures. And typically you'll find that a lot of these exposures are being taken by more evolved investors than I would say, others. We have to keep, talking about and giving the right kind of message all the time. Keep training them in terms of how to build portfolios, and to ensure that, that they're not got too much of risk piled on, in their portfolios. And I think that job of Amphi and the industry is continuous, whether it's Gen Z or whether it's, so many new investors who are going to come into the market in the next couple of years. So it's a continuous effort that, we have to do.
Right. Sandeep, quickly, with the recent correction, do you think this young generation investors are reconsidering their FIRE goals?
In fact, every time the market corrects, the question that we get is how much more can we put in right now, right? So I think because they've seen up moves, they feel that this is an opportunity to get in. And sure, I think depending on everyone's own financial situation, I think that's it. I think, frankly, look, most of them are in it for the long term, at least the clients that we deal with, right? They are not panicking. They are staying invested. They are asking all the right questions that, am I in the right portfolio mix? Should I increase some fixed income allocation? Their awareness towards bonds, and there are a lot of bond platforms which have done a great job of educating investors about fixed income options. So there is that awareness. The concept of asset allocation, a lot of them are actually familiar with. So I think I am actually very positively surprised by the amount of knowledge and information that they have in the client cohort that we deal with. I don't think they are reacting to near-term situations.
Fair enough. We are out of time, I think.
I just have one thing
Sure.
to say. I think the youngsters today, some of them who are working for these big tech companies, actually get a lot of money very fast. I think it's important for them to realize what is asset allocation and what should be their kind of strategy for. Sometimes when you're flushed with a lot of money so fast, you need advice, you need an advisor to give it. So this even answers Malakshi's question when she said, how does 50 fund houses and 1,700 schemes and so many, reach? I think the awareness building by advisors like us, there are only 900 RIAs, there are 2 lakh MFDs, and there are these platforms. There is a need for one-to-one discussion and customer. So he said, I think a combination of both tech as well as advisory is what ultimately would lead to.
One last rejoinder there. Whenever somebody has 10 lakh rupees and you want to anticipate what kind of questions that you will get from them as a wealth manager, put that down in ChatGPT. Ask ChatGPT, I have 10 lakh rupees, what should I do? It'll tell you asset allocation, it'll tell you diversification. And those are the questions. That's the starting point for most of these younger folks.
Right. So I think we are at the end of the session. Thank you all for the lively discussion.
Thanks a lot.
Thank you, Abhinav. Thank you, panelists, for such great insights. Moving on then, we are moving into our final segment of the evening. It's time to talk about one of the most closely watched spaces in the market, small cap stocks. Now, after a sharp correction followed by a strong rebound, the big question is, how do small caps compare with large and mid caps in terms of risk reward today? As India moves closer to the $1 trillion AUM dream, small caps could be the key to unlocking the next wave of alpha. So has the rally paused, or is this, is the party just getting started? Let's find out. Please join me in welcoming our expert panelists, Rahul Singh, CIO Equities at Tata Mutual Fund, Ashish Tavakle, Deputy CIO Equity ICICI Pru AMC, and Niket Shah, CIO Motilal Oswal Mutual Fund, for this much anticipated wrap-up discussion. Please give them a huge round of applause. Thank you for all of you for joining us this evening. Of course, the topic of discussion is very interesting, small cap stocks, a lot of interest in small cap stocks. And, small caps have thrown quite a bit of a party, right? If you see the last 5-year returns, for the small cap index, small cap 100, the returns have been in excess of 250%, almost 300%, 4x returns. If you compare it with the Nifty returns, it's somewhere around 140% or thereabouts, right? So it's been quite a party. But the narrative has been shifting. If you look at the last 1 year, the Nifty has given much superior returns when you compare it to the small cap index, right? Very first thoughts as to where we stand in the small cap cycle right now. Would you call it a healthy pause, or would you say that, would you call an end to this party now, Rahul?
No, definitely it's a very, very healthy pause, and I wish and hope that it lasts a little bit longer. But markets being markets, you cannot have your wish all the time. So we have to make most of where we are in the situation. Good thing about small cap compared to mid cap, since you mentioned mid caps also. Mid caps, the sample is smaller and the valuations there, at least optically at the headline level, is much more expensive than small cap. In small caps, you get more choice. Obviously, there is more risk, more volatility. So what we feel, or what I feel, is that in small caps, I think growth is being priced in. The pricing of risk is right now not that appropriate. And to that extent, you will have these cycles, you'll have these pauses. And the more we have these pauses, the better it is, because otherwise we end up creating bubbles. And when those bubbles burst, then it's very painful, and then the investor experience is not good. So pause is much better for investor experience, because I think the SIPs continue. I think so. People who invested between November 2021 to March 2023, there was a long pause. We've forgotten that there was a pause of 18 months. But people who invested there reaped the benefits of that between 23 and 24. So if we have another pause of 18 months, what's wrong with that? And those are my initial thoughts.
Sure. Coming to you, Niket, would you concur with that? Would you call it a healthy pause, or would you say that we may be nearing the end of the cycle when it comes to small caps? No, I think Anish, would you like to take that question?
Yeah. So I think we are coming to an end of the cycle. Clearly, we are seeing meaningful amount of opportunity in the small cap space right now. And I think one needs to keep in mind we run concentrated portfolios. So we essentially only look at 7 or 10 stocks in a year. And there are plenty of opportunities. I think the challenge in small cap is liquidity. You might get a fantastic idea with 3x or 5x return over the next 3 years, but do you get enough amount of stock? That's the big question in the small cap space. The other thing that one has to keep in mind is earnings growth. Small cap continues to grow almost at 15-16% in the last quarter, which is still far higher than large cap. FI holding in the small cap is probably at this highest level ever. The small cap and the mid cap share of profit in the entire market cap is now at almost about 27-28%. This used to be about 13-14%, and it's stabilizing at those levels, so it's not correcting. And last but not the least, what you have to keep in mind is liquidity, right? I mean, not liquidity from the fund standpoint, but also liquidity that RBI is injected in the system. All of that will have meaningful positive impact for the small cap going forward. But I think the next 12 to 18 months, one needs to be extremely selective. I don't think we'll have a broad-based small cap rally that we saw in the last 4 years. You have to be very selective, very stock specific, and stick to themes that you like.
We will come to themes in just a bit. I want to get in your thoughts, Anish. Would you take the middle path here? We have contrarian views coming in. And secondly, in terms of earnings, most of the downgrades have been led by the small cap space, right, for FY26. So where do you stand in this whole topic?
I'd be more inclined to Rahul's point of view, in fact, perhaps a little more extreme than his. So, when you said party, I felt, look, the only people having a party are actually the promoters who are coming and stuffing stuff down retail investors' throats. I think investors need to be very, very careful. And, it's interesting you mentioned 18 months of pause or 12 months of pause. Let me ask you a question. If you invested in a small cap index in December 2007, let's say end of December 2007, and you kept money in it for, 12 years, say entire schooling of somebody's child, what do you think the return would have been? So 2007 to 2019, before COVID. Can you answer that?
I would not like to make that guess.
There's one volunteer wanting to answer the question. So there are two indices that were in existence during the entire duration. One is the small cap 50, one is the small cap 100. The small cap 50 over a 12-year period was down 30%. And the small cap 100 was up only 1%, right? So the point is, if you enter at the extremes, that's the kind of risk you're taking. So all our enthusiasm for this small cap is based on the last 3.5 years or 4 years, where, to your point, right, the index has gone up 3.5 times, which means you've got a 250% return. But I do think at this stage still, right, There is a lot of froth in there. There are lots of companies with very weak business models, with very aggressive accounting, trading at very rich valuations, and people need to be very careful.
So, which are the pockets that warrant caution right now? You know, earlier the thought was risk hai to ishq hai. And, you know, that narrative hasn't really worked, you know, every time, right? So, which are the pockets that warrant a lot of caution at the current juncture?
No, I think in small cap, you have to be selective across the board.
Across the board.
Yeah. I mean, you have to be very selective across the board. I mean, you have to, in every sector, I would say you need to focus not just on the reported earnings, but the quality of earnings. You need to go through the balance sheets. Are people piling up inventory? Are people, you know, having very large receivables? What is the reported ROE? I mean, the reported ROE, I just did some numbers before I came here. If you exclude financials and IT where the ROEs are different, excluding financials and ROEs, the ROEs are sub 12% in the small cap space. So people are getting drawn in by, you know, by looking at EBITDAs and stuff like that, where you also need to see what's happening on the balance sheet across the board.
Sure. Rahul, in terms of opportunities, which are the pockets that have the potential to generate alpha according to you now? Since you are of the view that, you know, 12 to 18 months correction were pretty healthy, you know, if one were to look at this space, you know, where would you look at these opportunities in terms of alpha generation?
So, just taking off from what Anish was saying about 2007 to 19, I think the only thing which has changed between that period and now, that I think the entire cleanup was happening in the corporate balance sheets and the banking balance sheets. And I think there was, obviously 2007 was an overvalued market. And so I think today, thankfully, at least on the macro side, things seems to be a little better in terms of the balance sheets, government balance sheet, banks balance sheet, and the company's balance sheet. Company's balance sheet for a variety of reasons. Because capex has been low and also I think the equity markets have helped them to shore up the balance sheets and reduce debt. So the cycles will not be as severe. That's one conclusion in terms of the down cycle, if and when it happens, that 18-month period or 24-month period, whenever that happens. So that's one comfort one has. Having said that, I think in small caps, it has to be more company specific. You know, I think I will hate to get into themes now and discussion on themes because they are done to death. You know, whether it's defense or manufacturing, these are very generalized themes. And it is just not going to work from now on. It worked in 23, 24. It has worked partly in the last 3 months. But I think those days are over when we can just, you know, compartmentalize and say, okay, let's buy consumption, let's buy investment, let's buy defense and manufacturing. I think each company within manufacturing, because manufacturing is a big theme, right? It's a buzzword. But each company is so different that it is just impossible to bracket them together. And therefore, I think the starting point has to be valuation comfort now, today, especially today, wherever you have comfort. Wherever the expectations are low, I would go after that company. I'm not talking about theme here. And then you know, essentially have some theory on why we think that company will surprise whatever the expectations are. I think that's the way to build the small cap portfolio today. It is not going to work if you just chase power or defense or manufacturing.
You can't ride the wave blindly anymore. That's what.
Not at all. Not at all. Not in large caps, not in mid caps, and definitely not in small caps.
Niket, coming to you, we already had a discussion on you know, investment versus consumption, where, you know, panelists mentioned that, you know, there are various subsectors. But if I were to ask you about consumption in particular, you know, there are quite a few tailwinds, starting from tax cuts in budget, RBI rate cut, inflation cool off, you know, what have you. Would you expect, or would you say that consumption may emerge as the dark horse later this year?
No, I think on the low ticket size, yes, it's quite possible that it can emerge. But I think my fundamental premise is that the traditional side of consumption is not going to work. Like, for example, look at likes of FMCG. If urban salary growth is just 3%, I don't think FMCG is going to fly anywhere. And I think incrementally the new generation wants their spending patterns are far more different than the older ones. So as you see more and more newer areas of growth, like for example, you look at food delivery businesses, you look at quick commerce, and as Rajiv was saying about different concerts being sold out quite quickly. So I think the pattern of consumption is changing. It can really move more towards mobile phones, it can move more towards travel, it can move more towards luxury, so on and so forth. So I think what we have to keep in mind is that the consumption growth, spending patterns are meaningfully different than the last cycle or the last decade.
What would you do with shipbuilding companies? After defense and shipbuilding manufacturing per se, given the fact that post-Operation Sindoor, we've seen all these stocks making quite a comeback. They're all rallying with a lot of gusto and everything. Stocks like, I've just named one. We're not talking about particular stocks. For example, GRSC, shipbuilding company. Orders are flowing through. Stock is doing well. But would you be worried about valuation froth there? Because, ultimately it all depends on execution going forward, right? We're all betting on, what could happen in the future rather than, what's there on the books now.
So the way I'd address that is, our belief at iPro is always that if you like something at 100, you should like it less at 200, right? So after things have moved up, you should be trimming. I'm not talking specifically about shipbuilding. I'm just saying in general, because that means the good news, a lot of it is already in the price. So that's our general approach, right? We work contra, and stuff that has done well, we would generally like to exit, like to trim, in general.
Sure. I have a question then. Niket, we've seen small cap funds, mutual funds deliver phenomenal SIP returns, turning a 20,000 monthly SIP into 90 lakh in a decade, so to say, with 20 to 25% annual returns in top funds. Given the current environment of rich valuations and earnings downgrades, do you believe this kind of compounding story is sustainable in the next decade? Where do small caps really stand in this, trillion-dollar AUM dream?
Well, I think from a return standpoint, it's very clear that next 1 year, one really needs to mellow down their expectation. But it also depends on how your portfolio construction is. If you run a portfolio with 50, 70, 80 names, it'll be difficult for you to kind of generate that kind of returns. But if you run a portfolio where, say a small cap portfolio where you're running with 30, 40 names, and if you get few names quite right, it is still possible to at least get closer to those numbers that you just talked about. So I think it's all about individual stock picking abilities when it comes to small cap rather than mid cap and large cap, which is a little more generalized. But I think small cap is extremely bottoms up idea. Are you ahead in the curve? Are you ahead in the cycle? Really matters. If you are late in the cycle, frankly, you can't participate in small caps.
Rahul, how does one really spot red flags? If you're taking a bottoms up approach, how would you look at red flags, or how would you look at spotting red flags early on? Because we've had cases, especially for small cap companies, where corporate governance has been an issue, right? So, what makes you cautious, and what is the red flag that you really watch out for while selecting a small cap company?
Well, I think the biggest red flag before corporate governance always is the business model and the sustainability of it. We've seen multiple companies which do well in a window of 3-4 years. And then, something hits them, either disruption or competition, or the fact that they were just protected and they were just a below average company, right place, right time kind of a company, which did well in that 3-4 year period, 5-year period. And the mistake which investors end up making is to give that a very high multiple, that limited window earnings. It's happening, it happens in all the cycles, it will happen again. So that's the biggest red flag for me, more than corporate governance, because that's something which we can, which we should predict, and we are capable of predicting. In terms of corporate governance, I think there are multiple layers to it. Obviously, it starts from how your board is represented, what kind of compensation you're giving, then to the related party transactions, and also to the cash flow. I mean, major thing is obviously cash flow, because whatever you do in terms of cooking up your books ultimately shows up in cash flows. But, it will require a completely separate discussion on corporate governance. It's there are multiple layers to it, as I said.
That's true. Anish, just want to ask you about small cap funds. It requires 65% of allocation to small caps, right? They are highly sensitive to market volatility as well. In light of the growing geopolitical risks and valuation concerns as well, how should SIP investors in small cap funds think about risk management today?
So look, if you've had a SIP for a long time, right, then it's okay in my view to continue with SIPs. But what worries us is that people open SIPs in funds that have done well, or sectors and schemes that have done, or themes that have done well at the at high levels after they've done well, and then they get nervous after they've corrected. So look, I mean, if you're a financial advisor, right, and if you are confident that the client will stay invested, then it's okay to sort of have the confidence that the SIP is okay. But if you're worried that this guy has come in, he's saying he'll do an SIP, but I really don't know whether he'll stick in after 6 months, right? Then you're probably better off advising him to stick to a safer fund.
Sure. We're kind of running out of time, but I would just want to pose this question to Niket, and then I'll have one question for all of y'all. Niket, we know that the markets have been navigating the geopolitical risks quite smartly, if I may say so. Today as well, I'm just talking about today's market action. We saw very smart outperformance, by both the mid and small cap indices. What is it that stands out as a key risk for small caps? And do you think small caps are vulnerable to sharper drawdowns if at all there is a correction around the corner?
Always. So whenever there is a significant market correction, or whenever there is meaningful earnings downgrade in the system, or there is liquidity tide, you do see small cap having meaningful drawdowns. It's kind of played out every cycle.
All right. Okay, so as I wrap, one question to all of you. I know you guys said that, you won't be selecting themes or whatever, but, from a 3 to 5 year standpoint, would you be able to pinpoint one particular theme that could do well?
Yeah, I mean, I'll give you a theme which might sound very boring and very anti.
Boring is good, isn't it?
So healthcare is a theme which I like because, and I'm not talking about pharma here, I'm talking about healthcare. Because that's one sector, if you think about very top down, that's probably one sector where there is a demand-supply gap in India. I mean, any other sector demand supply gap gets filled very quickly. Look at quick commerce, or look at the new businesses also. So that's one area where there is a demand supply gap. Market is fragmented. There is pricing power. So you won't want to compromise in education and health. You don't want to compromise. So there is a pricing power. And I think, the opportunity to basically reinvest your cash flows into 20% ROE businesses can be there for not just 3 to 5 years, 10 years. Because we have to look beyond the demographic dividend story, which we have all grown up investing. Very soon we will be talking about healthcare and insurance in 5 years, 10 years, and not consumption. You can take it from me. And therefore, I think healthcare is one sector where for next 5, 10 years, I would like to pick up that as a theme.
Sure, healthcare. For Rahul, what about you?
So I'm glad you made a question 3 to 5 years, because that's an economic cycle. I hate to predict things beyond this cycle. No, but I think the economy is still doing well. It's recovering. So I do expect domestic demand to remain healthy. So I would pick domestic cyclicals, which includes capital goods, cement, financials, but selectively, and autos, right? So that's a domestic cyclicals theme as opposed to an export-oriented theme. Domestic cyclicals.
Okay. Yeah. What about you, Niket?
So I would think consumer discretionary is something that I would continue to like. Within healthcare, as he rightly said, a little more minutely, I would really look out for GLP-1's ideas. I think India is going to launch GLP-1. It goes generic next year. I think it will have significant ramifications on multiple sectors, from food delivery, food, beverages, insurance. Multiple sectors will have significant ramifications. And last but not the least, manufacturing. Within manufacturing, more on wires and cables.
All right, so those are the themes to really watch out for. I would like to thank you all for joining us this evening and sharing your insights. It was a pleasure.
Thank you.
Thank you. Big round of applause to the panelists. Well, with that, we wrap up the 4th edition of the Moneycontrol Mutual Fund Summit 2025. It's been an evening of sharp insights, meaningful conversations, and a shared vision for the future of India's mutual fund industry. A big thank you to all our speakers, panelists, honorees, guests, and most importantly, to you, our audience, for your time and engagement. We are also grateful to our partners for making this summit possible. Presenting partner HDFC Mutual Fund, powered by partner Axis Mutual Fund, knowledge partner K Fintech, event partners Motilal Oswal Mutual Fund, Mirae Asset Financial Services, Tata Mutual Fund and PPFAS Mutual Fund, and associate partner Reliance Industries. We hope this evening offered valuable takeaways for your investment journey. Let's now proceed for dinner. Good night and take care.